Well, thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Consumption is a bit of a tricky space to analyze currently, considering that there is certainly a K effect between high-end consumption and low-end consumption. And every sector or every company which deals somewhere in the middle out there is charting its very own course. Now, much to the surprise of a few people, Page Industries, when it came out with numbers, not only was the revenue growth impressive at 26% versus estimated 24%, but on the operational front, much higher than the guided numbers at the end of Q3. They delivered quite a spectacular performance. So for the quarter and for the year, Page had, one would argue, a reasonably strong one. The questions to Mr. Chandrasekar, he needs no introduction, Mr. K. Chandrasekar, would be about how does he see the year in retrospect and what does the strong exit mean for FY23, the first half, arguably in a period wherein there are question marks around how strong sustainable consumption would be. Mr. Chandrasekar, great having you. Hope all is well.
Thanks very much, and having Page on the show. It's a pleasure meeting you again.
Likewise.
It has been an extremely good year, the best in the history of Page Industries, both top line and bottom line. And we have done very well in Q3, FY22, which was the best ever top line. And the best ever bottom line comes in Q4, not very far behind the top line of Q3. So in the last 2 years, we have broken many our own records in terms of the best top line and bottom line. And we have grown about 37% in terms of revenues, FY22 compared with the previous year, and about 58% growth in PAT. It is so gratifying to see the kind of demand and the way the Jockey brand itself has been received by the market and the customers. And we have been consistently delivering high quality, premium, affordable products in the space in which we are operating. Going forward, even as I look at Q1, this year is also looking quite good, and we are on this growth trajectory.
Okay, great. I'll probe that a little. Let me first get a couple of other questions in, and then we'll talk about Q1 and the outlook ahead. So when I look at, and correct me if my numbers are not completely correct, but when I look back at FY22, about a 30% or 29% volume growth, couple of price hikes taken. Both of these helped you in your revenue numbers for FY22. How much of this might be sustainable on the price hike front, considering that there are raw material pressures that are evident in almost all books?
True. The volume growth was about 29% in FY22.
Right.
As I mentioned, the revenue growth is about 37%. We have taken a couple of price increases, about 5% in Q1 and about 8% in Q3. So that has helped us sort of recover the margins. The raw material prices increases have been pretty steep throughout not just FY22 but even FY21. It is sort of seeming to taper a bit in Q4 of last year and Q1 now. So it is sort of plateauing. So hopefully this trend will continue. And we have delivered 24% EBITDA margins in Q4. And our target is only about 21%, which we try to gain through the price increases. At the same time, some of the quarters we have better recoveries of overhead. So I would rather take it on a full year basis and watch. And if we need to increase prices, we have to, because it is inflation adjusted. The rest of the market has also faced not just the raw material price increases, but also supply constraints. And the reliability of the supplies have been affected a bit in the past. Right now it is fairly stable. So we have had pretty good terms with the vendors, and we take care of them very well, including early payment schemes and financing the vendors and so on. So we have very strong business relationships which have lasted us through the pandemic, and even now it is helping us to deliver the kind of results which you are seeing.
No, what I was trying to gather from you, sir, is Do you reckon that a stronger volume growth number might be possible in the near term, considering that we are hearing split commentary about how strong the consumption patterns in the country would remain? There is a bit of a question mark on that. What is your thought process? What is your experience thus far?
Definitely, we have worked very hard during the pandemic. There are many aspects and facets of the business which we had to reinvent. We had to rediscover our hidden strengths in the market and within our own team. So if you go back to the end of FY20, we had about 69,000 retail outlets, retail footprint. And now at the end of Q4, we have close to 1,15,000, and it would have grown by now even more. So we have almost, in a sense, expanded the retail footprint across the multi-brand outlets, the exclusive brand outlets, the large format stores. So we are continuing this, increasing the geographical penetration for Jockey, which we are only at the tip of an iceberg. As I sometimes say, we can be as big as another 4 to 5 times the kind of retail footprint that today we have. And that is only because of the strength of the brand, the way it is received in every new market in which we enter. And if you had observed what I had said, close to about 45,000 of these stores are less than a year old, or less than 2 years old. So naturally, they will start contributing even more towards, in terms of volume, in terms of their expansion into other product categories that will be presented on their shelves. So we are at a cusp where many of these new stores will start delivering even more volumes as we go forward. Plus, there will be increasing penetration of the brand, because there is always a demand for the product to be closer to the consumers across the length and breadth of India. And therefore, in terms of volume growth, our expectation is to sustain and grow the volumes even further if we can.
You don't reckon demand side could be an issue?
Demand has never been an issue. Even during the pandemic, all the categories have grown. All the categories have seen extremely good demand. And since we are in geographies where we have never been before in these last 2 years, there are a new class of customers and consumers who are coming into the Jockey brand. People have obviously heard about the Jockey brand, and it is present online. So for the first time, they had this shopping experience with Jockey because, for example, you don't travel, 10 kilometers to buy, for example, an innerwear. So therefore, it is essential for the brand to be closer to the consumers and in the geography in which they are, frequently shopping.
Okay. So am I getting this right? What you're trying to suggest is that if there were to be some drop in athleisure because the economy is opened up and people are going to office, or if there were to be some curtailment in certain areas, just the number of the presence on the number of points of sales that you have and the newer geographies that you are in will compensate for that.
One of the things I think we should talk about is the premium apparel segment in which we operate. The penetration is very low. We are only penetrated about 12% in the total premium market. And we are the largest by nearly almost 8 to 10 times the nearest competitor. So the premium market in the categories in which we operate, which is premium men's innerwear, women's innerwear, athleisure, and then all the others like socks, thermals, towel, and so on. The penetration of even Jockey, the market leader by a huge distance, is only 12%. So the premium market has not been fully converted. So there is really no question, no thought of a saturation in this market. There are many more players who have come in, and maybe today could be a tenth of what Jockey is doing in terms of value. But the premium market, the conversion from the economy space into a premium consumer is ongoing all the time, while the market itself is growing. So therefore, there is no even a thought or any observation of a saturation in any of the segments in which we are operating.
No, that might be true for the long term for sure, Mr. Chandrasekar. For the short term, could there be issues, or you don't foresee even in the short term? In the next 1 or 2 or 3 quarters, you don't foresee demand issues?
We don't foresee any demand issues simply because of the penetration. We have increased the footprint by almost 45 to 50,000 in the last 2 years, and then we will continue to do so at the rate of at least 15 to 20,000 retail new store presence in the coming year. So therefore, this saturation is not something which from the inside we have observed or seen in this brand, and hopefully we'll never see that for many more decades to come.
Decades to come, which explains the aspirational target beyond the $1 billion, beyond FY26 as well, right? You've kind of stated that in a slightly medium term, you hope to double that mark as well.
Yeah, the $1 billion is a kind of the lodestar, the aspiration which we had declared as something we look forward to as the next milestone in the journey of this brand. By no means, is that destination. We even now today talk of when is 2 billion going to come. So, and of course, since the penetration is very low and the acceptance of the brand, and it is such an affordable premium player in the space in which we are operating, any constraints will only come from within. How fast can we grow?
How fast do you think you will? How fast will you go, or how long will you take to reach the doubling of that aspirational target, Mr. Chandrasekar?
The doubling from here to 1 billion, we expect to be there in about 4 years' time.
Yeah.
It may come sooner than that. The way it is going, we are so encouraged by the results. We also know many of the constraints which we need to debottleneck in-house in terms of the production, the sourcing, the availability, and all those things. So we are increasingly investing in technology which will help us to be sharper, more analytical, and more precise as to meeting the demand.
What about the doubling post that?
That will be even faster, I guess.
Yeah, no, just trying to understand, because I reckon as the base goes up, the doubling picture is not that difficult in that sense. So good to know that. Okay. The other last, 2 or 3 more questions, some finance related stuff. So you obviously came in with EBITDA margins in Q4 at least. I know you mentioned that you want to look at the year, but I'm still trying to bring about the quarterly numbers because they were just very strong. And I heard you mention that the raw material surge has kind of evened out, or maybe started to peak out and has come off a little bit. So my question is, in the immediate near term, does the fact that you are sitting on higher margins than what you traditionally aspire, at least at the end of Q4, and that the raw material pressures might also be peaking out, would that mean that you would be in a better position to be able to push sales because you don't necessarily need to do more, and you have the margin lever as well at play?
There are multiple questions, very interesting ones. I am reflecting on your questions. The thing is, the margins in Q4, 24% was because of the 8% price increase which came in late Q3. So that has helped us to deliver better margins. But the raw material prices have continued to increase through Q4.
Okay.
Towards the end of Q4, it is sort of tapering, and we are observing similar pattern in April and May. But given the kind of volatility which we have seen in the raw material in the past 2 years, during the pandemic, during lockdown, and again when the lockdown lifted, there was a steep inflation in the raw material prices and all that. We cannot take anything for granted right now. So we have to really play the ear close to the ground and see what price increases, if any, will happen. Raw material is very important, is a big component of cost inflation, but at the same time, there are other inflationary pressures in the economy, pretty well. And every year there are salary increments, and every year there are increases in the value of contracts, which we do. So there will be some increase. Now, how much What is the quantum dictated by raw material? We need to see. And we don't push volume in the traditional sense. It is a pull demand from all the stores and the new stores and from the same stores. The pull demand of the product is always higher, and we always somehow only we don't supply to the full demand in the market. So our aim and quest has always been how to improve all the back-end operations to be able to deliver and service the demand from the channel. So if we manage to do that in the high 90s, we will be extremely happy. But there is still some way to go there with the technology.
Okay, no, but so just very quick clarification. Would you believe that would you maintain the margins where they are right now, considering raw material prices may have surged through Q4, but I heard you mention that now they've peaked, right? So would you maintain margins, or would you be even willing to give up some of the margins as well, if need be, if not in Q1, then in Q2, if sales were to drag a bit? I heard you say that they won't, but if they were to, would you have that lever? And therefore, can we take it for certain that the volume growth will not be a question mark in Q1 and Q2 at least?
Yeah, just for the sake of discussion, the volume, I mean, we don't chase volumes. At the same time, as I told you, that the demand is always much more than the supplies we are able to even today deliver in the market, even with on the back of all this strong growth. The volume lagging is not something we think about, is not an eventuality which we consider. Because until we are able to say we have supplied 100% of the demand, which we have never been in a position to claim.
Okay.
So therefore, the volume will not lag. The price will remain where it is. It will not go down, the selling price. And therefore, achieving the margins of about 20 to 21% with factored for whatever is the cost inflation is something we are confident of delivering.
Okay. Last question is on the international markets. It's not a very high base, but Sri Lanka is under a bit of an issue, though it may not be as material as well per se. But just talk a bit about how do you see the international markets?
International market is something which, because of the kind of growth we have seen in India itself, and as I said, the supply lagging demand throughout the history of Page Industries and Jockey in India, we haven't focused as much as we should have on the markets like Sri Lanka and Nepal and all the entire Middle East and Bangladesh and so on. Now there is a specific international market head who is extensively traveling and exploring the potential of the markets. Sri Lanka may be going through a temporary crisis. Hopefully, they will come out of it. And similarly, when we look at the Middle East, the market is pretty big, and where we can do much better. None of these markets, let's admit, is going to be the size of India. But then there is a certain potential which the brand can reach. And there is definitely a demand, because the Jockey is a well-known international brand. Even in these markets, there is always a certain hunger when we reach out into those markets. So we hope to leverage on this and give the brand its rightful presence in all these countries.
Great. Lovely getting that big picture perspective and the confidence, Mr. Chandrasekar. Thank you so much. Congrats on a good quarter, of course, and a good year, and all the best for many more.
Thanks once again.
Pleasure was ours. Viewers, thanks for tuning in.